What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today with Shane, and is it Pogue or is it Pogue? How do you pronounce it?
Pogue, second one.
Sweet, Pogue, excellent. And I got great news for you, Shane. I hope you're doing really well today. But today we are joined by, I don't know if you're aware of this, but we're joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate investors, deal sponsors, syndicators, operators, all that kind of stuff. And you might ask, why would you do that? And the answer is, if you've ever heard of an off-market deal, the private ones you're not allowed to publicly discuss, sometimes they're called 506B syndications, then you ought to know that the SEC requires that you have documentation of your prior substantive relationship, or else they'll get ants in their pants and they might take away your business, and that's bad. So I have people on here to find out what exactly are you doing in this industry? Is there any overlap with my business and that sort of thing? But before we get too excited about real estate, Shane, do you want to say a thing or two about yourself?
Yeah, so actually, I'm not an investor myself. What I do is I provide services to investors. So I provide due diligence support services. Our main thing is investigations. So we'll go really deep into the background of anyone you want to do business with, potential investments, and kind of pull all that information to the surface before you start spending too much money on it. That way you can get a good idea with who you're dealing with right off the bat.
All right. I love it. I love it. So let's go ahead and start the presentation right here. It's the 5 distinct motivations. Before I do that, I gotta go, but wait, check your 8. Shane, I don't know if you know how to do this or not. I can move it. There we go. Now we're a bit bigger, but maybe you can see through the camera and into the user's device, because down there might be this big hideous subscribe button that maybe they should do something about before the Zoomers they start getting all judgmental and all that. Okay, it's a dumb joke, but whatever. Let's get started. The 5 distinct motivations. One thing that's really important in this industry, because we're dealing with big numbers, we're dealing with people's big chunks of their life savings and things like that. You need to know, why is this person going to stick around in this industry? Because there's plenty of risks involved. After all, this is a mature industry, and you need to find out, when the going gets tough, what's going to keep somebody from throwing in the towel. And I found, even though everybody has their own unique why, I find that they fit pretty neatly into these 5 distinct categories. The first one is preservation of purchasing power. What's that? Some people already have a portfolio of assets, and the way that they make ends meet is not so much from a job like a W-2, it's because they get proceeds from their portfolio. And those who are new to this industry might say, well, if you're already in that situation, why would you go through the hassle of making another acquisition? After all, they take months to close, they take years to go full cycle, so there has to be something going on there. And the answer is, there's a few circumstances that stick out. One of them is, if inflation is rearing its ugly head, then you can bet it's going to eat away from the purchasing power of your cash flow. So it's going to be time to make another acquisition. But the other time, which everybody should try to purchase at the steepest discount they possibly can, but if you aren't in that big of a hurry, if you're already financially independent, you're not going to pull the trigger unless you're getting a steep discount. And that often happens because of asset crashes, different forms of distress, and that sort of thing. And full disclosure, I'm not there yet in my real estate career. What describes me best is I'm trading time for wealth. So rather than providing services like I have in the past, I own a CRM agency that I tend to go off and on with, and I ended up helping starting in 2014, a real estate firm that was doing 10 single family house transactions per month. And I realized that I was on the wrong side of the right business. So I decided to pivot my technical skills and marketing skills and online content to trading for little slivers of equity in people's deals for people who need my skill set in their GP team or something like that. So that's what I'm up to. I get that that's a little bit abstract, but a lot of people, they more resonate with the idea of fast tracking retirement, or at least regaining control of their schedule. So maybe they want to work fewer weeks per month or fewer months per year or something like that. And that's a fantastic thing that they want to hustle like crazy now to reap the benefits later. But other people, I think the real problem with this motivation is a lot of people think it's secretly everybody's motivation. And I assure you it's not. There are some people in this industry that are fueled more by ambition. They want to buy their entire hometown. They want to make sure that their name is on a huge building, and their great grandchildren never have to hold a day job. And I get that that's vilified in some circles. And I think that in the context of commercial real estate, that's not exactly a fair thing, because you need people who are motivated to stick around and do the job and hustle into their 90s. So that's why that's a perfectly valid motivation. Now, the last one, they also are going to be hustling into their 90s, but it's not so much because of their name and lights. They've picked a sector of society, or maybe it's animals, maybe it's the environment, maybe they want to send people into space. Who knows what it is, but if you want to make a big impact in the world, then there's a financial component to that, and that's why they're making their commercial real estate acquisition. Now, Shane, I get that you mentioned that you're not an investor and you're offering the services in there, but and so like I get it that it's going to be a little bit more transactional. It's not going to be like you're signed up for 10 years or something like that. But out of these five different motivations, what combination of them describes you best?
Probably help people who need it. One of the big reasons why I do what I do is because I saw basically people not having the service I provided at a good price. So you'd have people, there was really two different types. There'd be like people that kind of know what I do, and they're like, oh, how are you doing it like that at that price? And then there are people who just never had the coverage because they might have at some point become aware of it, but they saw the price tag and they're like, that's not going to benefit me because it's too much. So trying to cover that space to prevent like fraud is a really big aspect of what I do. And that's why I kind of go on things like this to kind of educate people. It's like, hey, this is a service out there that you guys can use. It's designed to help you. It's not designed, I'm not designed to take money out of your pocket. It's just, that's how much you have to charge.
I love it. I love it. And I love the fact that you're also just basically being real about it. And I think that there's a lot of rah, everything's all, rainbows and fluffy pillows and all that kind of stuff, when there's actually some real risks involved. After all, it's a mature industry and every business has risks involved. And this next little bit here is because I realize that you have to understand those risks and demonstrate that you understand them. But if you've ever been involved in one of the private syndications I'm talking about, these 506B, these off-market private deals, then whoever the securities attorney was in the mix, they should have required that everybody involved fills out this super invasive questionnaire. It's registered investment advisors and whatnot. They also have these suitability questionnaires in there. And when I was going through those papers, those questionnaires, it's asking all about all these things that are uncomfortable to discuss, like your net worth and that sort of thing. But the question that jumped out to me the most was the tolerance for risk assessment question, because I felt it didn't matter which answer you gave, it wasn't really usable because it's just too subjective of a thing. So I made my own version of it, which is a fill in the blanks question. It is. There are many popular investment asset classes, but I think blank is too risky. So Shane, the answer can be inside real estate, it can be outside real estate, it can be both if you want, but what's too risky for you to invest in?
I'm going to have to say online video game advertisements. I've seen this pop up a couple times where people had actually wanted me to run due diligence on it. I'm like, that's going to be very high risk, just like on the initial risk assessment call. I'm like, that's super high risk. And I would never invest in something like that just because you're dealing with a very niche service where the people that are probably offering that service are also already high risk.
Mm-hmm. Mm-hmm. That makes lots of sense. And I hear Puppy is not too happy about it either. It's like, oh no,
No,
don't
no.
invest in those ads. Oh, it's terrible. But jokes aside, let's go to the next frame. And I gotta confess here that for the first couple hundred chance encounters, I wanted to include this, but I didn't. The reason why I didn't is because I know some people in this industry, they're really more the front of house, the marketing, they're not the spreadsheet people who are doing the underwriting, figuring out exactly how this business is going to proceed. And I didn't want to alienate people like that because they still serve a valuable purpose. But I found even if your job is being front of house, you're still going to focus on a few different metrics in order to distinguish one deal from another. So I've got this frame with 14 different metrics on it, and I go through all of them in case anybody in the audience is only listening and not watching. They are cash on cash, IRR, which is internal rate of return. Then you've got cost per door. You've got net operating income. You got the going in cap rate, which really is dictating the discount that you're getting compared to other buildings, other commercial properties in that area, because the big companies, they do have the standard, the going cap rates published. They let those out. Then there's the loan interest rate, which is especially important right now because a lot of people are trying to assume loans. There's occupancy. This is very multifamily leaning in that sense, but occupancy is also the inverse of the vacancy rate. So it's the same number, just inverse. Then there's the average income where the property is located. There's the amortization period of the loan, which also comes in, especially if you're going to be assuming a loan. There's the difference between the market versus in-place rents. There's the population growth where the property is located, which gives a little bit of additional demand in theory for the property. Then there's the sponsor record, which is how many deals have gone full cycle, how many deals are on the go. Then there's the waterfall split or exit strategy, which is about what happens to your investment after your capital, your principal has been returned. And then I have DSCR, which is debt service coverage ratio, which is how much of the revenue is going out the door immediately just to pay for the loan, which is also another way of saying how much leverage is there. So Shane, I don't know if you want to give like a top three or something like that. I get everybody has their own different numbers, but which ones do you tend to depend on most?
I love going with sponsor record just because that's kind of what I do on. Because if you have a good team, this is the same with in a lot of different spaces like venture capital. If you have a good team and you vet that team and you go through and you say, hey, I want to work with these guys. It doesn't even really matter if the deal doesn't go as well as they thought it would. That team is going to deliver you some kind of result, even if that result is, hey, we messed up here. We're going to try better next time.
I love that answer. Let me see here. What am I doing here? I'm just gobbling that up like a delicious subscribe sandwich, which is my big indicator that it's time to bring out the Dan Does Deals Commercial Core Competency Cube, and it helps if it's the right way up. And what it has is the 6 core roles in a commercial real estate deal. It does lean a little bit towards the multifamily side because my guests have traditionally been mostly in the multifamily space. But the reason why this is so important to go through and why I do it in every episode is because I want you to be able to more effectively communicate on the subject of commercial real estate deals, because I realize that if you're going to make this part of your career or your investment strategy, it's going to hinge on your ability to effectively communicate. And if you're watching me go through this demonstration and thinking, wow, I really need to get me one of those cubes, well, the good news, it's absolutely free. You can go to dandoesdeals.com and there's this big conspicuous looking button you can click on and print it out. That's right. I committed the cardinal sin of marketing, which is you should never, ever, ever give away your freebie without asking for some sort of contact information like an email. But that's how important this is to me. But the other thing that you're going to get from this is you're going to have a better idea of how my guests fit into these deals, which is one of the most important things I'm trying to provide here. So let's get started. Let's talk about repositioners, who are the most visible people in a commercial real estate deal because they're the acquisitions people. I imagine Shane is going to be working with all sorts of different repositioners while the repositioners are busy doing their paperwork. What's this paperwork? Well, first of all, you need to make sure that the property is actually making the amount of money that the seller slash broker claims it is because right? The repositioner has to figure out what the truth is, but they're called repositioners because they're also figuring out how can they pivot the property, how can they change it so that it's making more money than it has been in the past. And one of the most peculiar ways that repositioners pull that off, it's a bit of a weird one when you're coming into this industry, saying, why are these repositioners always interacting with financiers? And financiers, just for clarity, those are people who only deal with the owners of the property, paperwork, and money. So they don't have an active role in the deal, but of course, there's somebody in the deal who's going to be in charge of financier relations, and everybody's going to have their own group of financiers. But the purpose is because if you can secure a more advantageous loan, that goes straight to the profitability of the building. So that's why those relationships are so important to building commercial real estate. But the next place that a repositioner is going to look is in operations to say, how can we get those Benjamins to stop going down the toilets? Now, of course, there's more to operations than just unclogging toilets and collecting rents and mowing lawns and things like that. Me personally, my contribution when I've been on a GP team in the past, it has to do with the online factor of this business, like creating web-based assets, marketing materials, and things like that, which that might not seem that important. But the fact is, even if you are looking for the bigger properties, as I've tended to target in the past, the enemy in commercial real estate is vacancy. And even if you're outsourcing your property management to a third party, somebody on the GP team needs to have some marketing chops to make sure that they can step in and fill those units if the property manager is unsuccessful at it. So that's where I throw my hat in the ring. But of course, the next part that a repositioner will look at to get more upside is they'll get a contractor team involved to do a value add. In other words, they'll upgrade the property, the idea being that the future residents or tenants will be happy to pay more in rent than the previous ones because it's a nicer place. But if only things were that simple. Like, you can go ahead and spend money on things like gold plating the toilet, but it's not going to get you a decent return on investment. And that's not the only way that you can lose on contractors, especially if you're like me. See, I don't know if you know this about me, but I'm from the internet, which means I need somebody to keep an eye on those contractors to make sure that they're keeping to schedule, they're not using subgrade parts and materials and that sort of stuff. So that means I need locals. I need boots on the ground who can be there in an hour or two, because categorically, that will not be me. I'd still be stuck in an airport in an hour or two. So you need somebody else on the team to rely on for that. Now, of course, the next part, the sixth side in the cube, it takes a little bit of a hypothetical to explain it best. So let's say you in the audience, let's say you're a physician or an attorney or an engineer or something like that, and you say to yourself, hey, I know how rentals work. You know, I put down my deposit and then I borrow the rest. So I bet if I get my circle of friends to each put in like 100K each or something like that, we could take over that 350 unit apartment complex that's just down the road. So full of confidence, you turn around to the financiers, the banks, the lenders, and that sort of thing, and you say, hey, I want to buy that building. It's tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Well, there's going to be a problem with that question because the financiers are going to ask you, who's the deal sponsor? Who's the KP? What's that all about? Well, all of these different lenders are in the industry of protecting capital as they lend it out. So they need to make sure that whoever they lend the funds to isn't going to just pick up the property and then run it into the ground, making it impossible to recover that principal. So they're going to require that somebody in the fold already owns a similar asset, okay? Or else you're just not going to be eligible for a commercial loan. So on top of that, finding that KP who's involved, who's already owning a similar asset, you have to have a certain amount of liquidity to prove that you can run the business, and you also need a balance sheet, in other words, collateral of at least the amount of the loan. But if you got all those pieces, you got yourself a commercial real estate deal. So Shane, you help in the due diligence. So I imagine you're helping the repositioners and the sponsors, and sometimes the locals who end up getting properties under contract with an LOI or something like that. But I don't want to put words in your mouth. Have I got that about right, or where do you fit in?
Oh, you got that exactly right. We actually also help vet things like contractors as well, because that is a really important part that usually people don't go, oh, due diligence on your contractors. But it is a really big part in other spaces. For example, if you're a registered investment advisor, the SEC requires you to do due diligence on some contractors. But in spaces like this, they're like, well, I know the guy who recommended them, it's fine. And then come to find out the person you're hiring to go through your property and upgrade everything has a criminal record.
Mm-hmm, mm-hmm, mm-hmm. I love it. I love it. So let's talk about buy boxes for a second, which is the actual properties themselves. When real estate people are asking each other, hey, what you looking for? What's your buy box? They're really asking for three main things. The first one's geography. Where is it? Which state? Which county? Possibly even which neighborhood. Before you call it ideal, then you're going to need to know where it is. The second one's size. I said before that predominantly my guests on this show are in multifamily, and the way that you define size in a multifamily property is by the number of apartment units. And the reason why it's so relevant for real estate people to know what sort of unit count the person is looking for is because the type of team that's going to take over a 10 or 15 unit apartment complex, they're going to be fundamentally different from the ones that are aiming for the 150 unit apartment complexes. So that size definitely matters. Now, of course, there's other forms of commercial real estate that go off of either acreage or square footage and that sort of thing, but that size consideration still applies. But the third one is normally called class. I prefer the term desirability because there's two distinct portions of class and they still use the same word anyway. Those are the condition and the area. And if you're talking about condition, it's how old is the facility, how beat up is the facility, what kinds of luxuries and amenities do they have that make it more desirable. Whereas if you're talking about the area, then first of all, there's that old trope of location, 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 which I really think means more traffic, traffic, traffic. Any place that gets a lot of traffic going by is automatically going to be more desirable than one that gets less traffic. But because we're often talking about multifamily, you also have to think about the school districts where the property is located, because that's another thing that makes it more desirable. And then the last one, of course, is the crime rate, which is relevant to all forms of real estate, because you need to be able to feel safe if you're going to be working or living there. Now, both the area and the condition are ranked the same way as in grade school, where you have A plus at the top and then A minus and then B plus and so on. So Shane, again, you're doing the due diligence for different deal sponsors, repositioners, and whatnot. If that's the case, like what's your sweet spot as far as what kind of properties you tend to help with?
So we help with a little bit of everything when we're doing, and sometimes it's not, hey, we're going to a specific property. Sometimes it's, hey, I want to do business with a sponsor in the future. What can you find on them? So when we do have a specific property, we do look at certain things. For example, the crime rate in the area. We do put this up on our reports, but honestly, most of our clients do it themselves as well. But occasionally I'm able to add some value there by going like, oh, hey, that crime rate you sent me over, it might not be exactly accurate because you looked at 5 years instead of 10 years, and it looks like it's actually going down overall. It's just it had a slight jump over the last 5 years.
Mm-hmm. I love it. I love it. So the next question is usually what kind of people you're looking for. Me personally, because I'm the internet guy, I recognize that everybody in this industry is ultimately looking for people to help them deploy capital. But because I'm from the internet, the deal sponsors, the KPs, are the people who I usually try to attract, just because they've got a foundation of business put together where a person like me can make a disproportionately big difference. Because if you're just getting started off, then you need grunts who can put in 80-hour weeks without breaking a sweat. And that's just simply not where I'm at my most effective. But the way to as far as you go, Shane, you mentioned the ones that you're interested in. So let's talk about the channels on how to reach out. Me personally, I got this really distinct last name. It makes me really easy to find, especially on LinkedIn, which is where I spend most of my time. But if you are going to be raising capital, if you've got a business that you want to get passive investors for, I highly encourage you to pause the video, scan one of the 2 QR codes that are on the screen, because that goes to the FAQs page of 506 BME. It's a platform where we offer the backup and creation of your documentation for your substantive relations within these deals. And the idea being that you have to have a plan if your laptop falls into the bathtub and the SEC asks for the documentation to your substantive relationships with your different partners. But Shane, I know you're active on LinkedIn. Is that the best place to reach you, or is there a website or something that's better?
The LinkedIn's probably the best way. Pretty much always on there. My website is still through Squarespace. I haven't built my own out, so their messages go through email and then get to me afterwards. So I prefer people contacting me on LinkedIn. It's much quicker. We can send out an invite, get a meeting together just to get together real quick. Say, hey, can I actually help you? What are you doing right now? What can I actually add?
I love it. I love it. And that brings me to the last thing, which is my public service announcement. It's actually not for you, Shane. It's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs and migraine symptoms, I'm confident it's because of the downright hideous subscribe button down there that maybe you haven't hit yet. And as I said, the Zoomers will judge you if they see that you haven't subscribed. They'll be like, I thought I knew you. Okay. Full disclosure, I want a lot of people to click that subscribe button so that YouTube starts to pay for these videos instead of me. I'm almost to my 1,000th subscriber now, and so this is a big deal for me. The trade-off to you, just so we're clear, you might not even see my videos on your list of suggestions. You might not, but that's really the only trade-off, because it's free. And honestly, though, you can go ahead and ignore those suggestions, because quite frankly, I just appreciate the fact that you spent this time with me. Just like Shane, I appreciate you joining me. This has been great.
I appreciate you having me on.
Does nothing but put more money in the pot.
Right.
If we talk about just the investor side, I mean, Shane talked about the sponsor side a little bit. I'll talk about the investor side. Okay, so you want the most money in terms of return with the least risk. All right, you want to do it yourself, you can go get 13 or 14%. You're going to do all the underwriting. It's not going to be passive.
If you bet, probably not.
I think I'd have to bet at least 2,500 before they fold.
And the pot is
4,000.
4,000. Yeah, I think you're right, but I'd rather just check.
Okay.
First position, you have the right of collection and the right of foreclosure or sheriff's sale, wherever you're at.